Good morning, everyone, and welcome to the European crossover webinar. And we have seen equities pull back a bit here. Bear with me. I'm taking a look here with the euro, which had really made a pretty good run up in here, and actually the dollar taking a dip. Actually, the dollar came into our bias chart support on that we had for Friday, right here. This 96.43 or 42 was that we had listed here, but the euro certainly has made a pretty nice run here. Challenging almost all the way to 1353, or actually I think it's right, there's 1356 is a weekly level. When you look back, and we had not been able to close above that either on Thursday or Friday, and obviously we pushed a little bit lower, and the market had stretched quite a bit. I mean, quite a bit of a phenomenal run that we had here with the euro. So just easing back some. I think we have support coming in around 1245-ish. There's a level here, 1285, but we may have to go in and test down there around 1240s to find some support here, or where buyers will be willing to go in and step in. And also looking at the cable, we did make another run here towards this 2742. I was surprised that we made it that strong, although we had closed above this key weekly level, 2602. So the next key resistance level to challenge is 2742, and we actually even challenged it, into this session here. Thought we might have to pare back a bit. So it's been quite the move here, as well as here on the dollar yen. Same thing here, quite a run up in here also. Closing above that key 933, opening the door for us to potentially go as high as, very key area here is we do have resistance around 987, but 1007 here, 1017 will be key levels, especially if we close above 1017. And the dollar CAD continues to languish here. Moving into the equities, we did see another high here on Friday as we pushed even higher. The market even got above 3,200. We opened there in the Asian session, or we actually challenged up in here to 3,210, and we've been on a bit of a slide since then. Actually, the low level in the Asian session was right around 3185 before rebounding almost here to 3,200 and then dipping back to make a new low at 3183, and we're just languishing here around 3190. Looking here in the 2 hour, still once again pretty stretched, but once again we had runs across the board. Even the NASDAQ making new highs on its run up in here, and we're looking at the Dow futures, but even the NASDAQ going to new highs. And you can see here with new highs here on the NASDAQ. And the BKX and XLF had still remained above these key daily levels here. So certainly was giving an indication that it had still had run out of gas. I mean, these are these key daily levels, and they were still well above those. Even the high yield had gotten above and still remains above that for now. So wasn't anything necessary to go in and suggest it was run out of gas. Now, gold had really come off quite a bit from its levels, and finally made down here, saw a bit of a hammer at the 1675. We've kind of worked a little bit higher since then, but it too had remained under quite a bit of pressure. Then looking ahead out for today, we do have employment trends. It looks like that's the only data that we're going to have coming out for today. Although it looks like I have to update this a little bit further. But at least for now, that's the only key data I show here. With me. See if there's anything else here. It looks like it'd be a quiet Monday as far as data. And let's just go and take a look at a couple of stories here. German lawmakers see way out of ECB court ruling conundrum. A cross-party group of the German lawmakers want to work with the European Parliament to resolve a challenge from the Germany's top court to the European Central Bank's flagship policy program. The Frankfurt Allgemeine reported German Constitutional Court last month gave the ECB 3 months to explain the proportionality of its bond purchases or risk losing the German Bundesbank, one of 19 national central banks that are members of the ECB, as a participant. It also called the German parliament and government to challenge the ECB on the matter. The ruling poses a conundrum for Berlin, which is bound to respect the Karlsruhe court, but at the same time does not want to erode the independence of the ECB, whose unprecedented economic stimulus program has kept the Eurozone intact. The Frankfurt said in an advance release from Sunday's edition that an idea floated by Sven Simon, a member of the European Parliament with Chancellor Angela Merkel's Christian Democrats, was emerging as a potential solution. Simon suggested that the Bundestag, the lower house in the Parliament in Berlin, should demand a statement of clarification for the European Parliament rather than the ECB. Unlike national parliaments, the European Parliament has a right to put questions to the ECB, and the ECB president gives testimony to the European legislature in regular hearings. Simon has therefore written to the ECB asking it to make its internal deliberations on the effects of its policy action public. If it did so, it would, in Simon's view, make it clear that it had in fact carried out the audit that the Karlsruhe requires, the newspaper reported. The bank is obliged to reply, and the Christian Democrats, the Bavarian sister party, the Christian Social Union, support the proposal, along with their Social Democrats, coalition partners, and the opposition Greens and Liberal Free Democrats. Now, whether that may or may not cause a little bit of a dip in the year will remain to be seen. And just looking here if there's any stories out for the morning. Just checking here on Reuters. And just something just to set up the week. Global markets and Asian stocks hug 3-month highs after surprise U.S. recovery, and oil ticks up. Asian shares advanced on Monday after surprise recovery in U.S. employment lifted hopes of a global quicker global economic revival after many weeks of lockdown aimed at controlling the coronavirus pandemic. European markets were headed for a weaker open with pan-European stock, Euro stock futures, 50 futures down 0.5%, and FTSE futures easing 0.3. S&P futures inched 15 tenths higher, but gave up most of those gains earlier in the day. As we get more and more data that perhaps it confirms the economy is really on the mend and the second wave of infections may not be very severe, then that will boost the confidence even further, said Vasu Mendan, senior investment strategist with OCBC. The broadest gains of the Asian Asian Pacific shares outside of Japan rose 0.25%, extending gains to the 8th straight day, and the index has surged 34% from four-year lows. The new wave of optimism was triggered by the U.S. non-farm payrolls, which unexpectedly rose by 2.509 million jobs last month. The Labor Department closely watched employment report also showed a surprise fall in the jobless rate to 13.3%. The data raised hopes of a quick economic recovery as governments worldwide eased social curbs aimed at stemming the virus. There are many clients who are cash rich and are prepared to put money to work. The fear of missing out is very much real, said OCBC's Menyon. You are seeing clients actually wondering whether they should get into the market because they are suddenly seeing the momentum turn. The jobs data also bumped up the U.S. bond yields, with 10-year yields rising as much as 0.959 on Friday. The sharp gains in the U.S. bond yields over the past couple of days put more focus on the U.S. Central Bank, which will hold a two-day policy. The Federal Reserve Chair Jerome Powell said the U.S. economy could feel the weight of the economic shutdown for more than a year. Chinese trade data published on Sunday also revealed the impact of the coronavirus. Experts contracted in May as global lockdown continued to sink demand with a sharper than expected fall in imports. In Japan, revised gross domestic product data for the first quarter showed the economy contracted less than initially thought. The outlook suggested the nation was facing its worst post-war slump due to the pandemic. The market has been rallying on hopes of economic reopenings, but the actual oil demand has not risen in that much yet. In a way, the market is supported by a flood of liquidity, said Tatsufumi Okashui, senior commodity economist. The broad investment in sentiment weighed on both the safe haven Japanese yen and the dollar. So move these out of the way. And then lastly with the dollar. The dollar back on foot is more signs of a point to economic recovery. The dollar fell against the Antipodean currencies and the British pound after a surprising movement in U.S. labor markets bolstered expectations for economic recovery, which reduced safe harbor demand for the greenback. The Aussie New Zealand dollars both rose to the strongest since January after data showed a smaller than expected fall in Chinese exports. In contrast, the U.S. dollar traded near its highest in more than 2 months against the yen, supported by recent gains in long-term treasury yields as investors await the outcome of a two-day U.S. Federal Reserve meeting ending on Wednesday. Sentiment has improved dramatically in the currency markets as traders look for signs of a rebound from the coronavirus outbreak as economies reopen from lockdowns. Commodities and emerging market currencies are clearly finding it easier to rise against the dollar on hopes of economic recovery. But it's a different story when it comes to the yen, said Junichi Ishikawa. For the dollar yen, the focus is more on yields, which is pushing the currency pair higher. Japan's economy shrank less than the initial estimate in the first quarter, revised data showed earlier on Monday. New Zealand Prime Minister Jacinda Ardern on Monday said that the coronavirus measures in the country will be lifted from Tuesday, barring closer restrictions against the pound. The dollar fell to 27.02 on Monday, closing to its lowest level since March 12th. Underpinning sentiment was a surprise recovery in U.S. employment in May after the economy suffered record job losses. Some investors may avoid making big trades before the Federal Reserve's meeting on Wednesday to see how Jerome Powell views a recent rise in 10-year yields and a steepening in the yield curve. The pandemic first emerged in China last year and it caused a sharp contraction in global economic activity, but many traders are now focused on the pace of recovery in the second half of the year. Some analysts said there are still many risks to the outlook, including any second wave of infections, diplomatic tensions between the U.S. and China, and U.S. presidential election later this year. And with that, we're going to move into the analysis. There we go. Okay, so let me put this on here. So the euro challenged at 114 with a high of 1383 on Friday. The pair closed below the weekly resistance at 1356. We were pointing that out a little while ago. A pullback to 1245 will be support with resistance at 1334. So once again, like I said, we did go and pull back to this 1285 just a little while ago. We're pushing a little bit back above it, but resistance is going to be 1334, and you've got that huge weekly resistance here at 1356. So once again, for resistance today is going to be 1334. And support's going to be 1245. Looking further out. Now, like I said, this 1285, if you consider how far we had come back, is pretty decent area, and we've even bounced off of it. But once again, if you're looking for a little bit further pullback, when you look at this huge move, then you're going to see better demand coming at 1245. Looking at a cable. Cable mounted a solid close on Friday, clearing weekly resistance at 2602. The pair came up short of the level of 2742, which will be resistance to start the week, which obviously that capped it, or at least has. I mean, they've challenged it already this morning, which will be resistance to start the week. Support will be 2566. Thought we might be able to pull back just a little bit. At least for now, you're looking at this 2602, which is key weekly resistance. I mean, right now we're 2695. I think we can eventually pull back further, but at least for today, we're going to have to relinquish to go with this 2602 because we're still holding up very well here. So we'll keep it a bit tighter, considering that it even challenged, unlike the euro, we've even challenged these highs again since Friday. So we'll go with the key weekly resistance, which is going to be, which now support 2602. The market even closed above that. So that would certainly be the first initial key support level. And beyond that, if you're looking for further pullback, would be the 2566. Resistance is going to be the challenge that we went to, this 2742. We've already made a move towards that this morning. And we're going to move on now to the Aussie dollar. So the Aussie, another day, another new high. The pair closed at 69.75 with now resistance now at 70.27 looming. Support will be 68.96 followed by 68.45. So this thing is just absolutely relentless. But one of the things that has helped the Antipodean currencies, we did see where Prime Minister Jacinda Ardern, New Zealand Kiwis Prime Minister, said everything's opening up on Tuesday. So certainly we may be getting this last hurrah. I hate to call this the last hurrah, but look, even as tight as this has been, look how these gains have just continued. You can see just pushing higher, pushing higher. And the odd thing is, not odd, but look, you would think they might run out of gas because look, this tight range and we finish center wise. Same thing here, tighter range center wise. Up in here, we finish a little bit lower. I think we might be reaching maybe as far as it can go, but that's the last bit of, I would think, very good news. But you can see here at 70.27 is going to be resistance. Actually, we had that from Friday. See this move here. You can see the significance of the 70.27. You see that right here? Going all the way back to October of this last year. And actually October of 2019, right there. And for support, 68.96. Moving on to the Kiwi. Also, it helped out. Remember, the Chinese data was not as bad as could have been, so that gave it an extra boost. Boy, they are really pressing the shorts on this stuff. I mean, whether it's the Aussie or even more so now the Kiwi. As I said, the Chinese data wasn't as bad, and on top of that, everything's opening up in New Zealand, according to the Prime Minister on Tuesday. So that's giving it an extra boost, and boy, it's a pretty good solid boost. So the Kiwi climb remains rampant, closing the week above 65. The next level of contention is 65.45. Support will be 64.35. So look at this here. This is the next one right there, 65.45, and we're not too far away from that. I mean, anybody standing in the way of this, it's tough. Hopefully, I mean, for those that are short, and I see some of y'all are short, maybe this will be the last hurrah. Like I said, not only did helping it out was the Chinese data wasn't as weak, but also everything they've already announced, everything's opening back up on Tuesday, so that might be the last bastion of bullishness. Had it been, not that that's not bullish, and that is very bullish, but maybe if it was the market was caught a little bit short or more short than it already is, we would blast it up on those news, bust up on that news, or maybe at least pushed up another 75 pips. So maybe we'll kind of run out of gas because that's pretty good news because they're fully opening up on Tuesday. So the 65.45, at least if you're bearish, hopefully we'll cap that. Support will be 64.35. And we'll now go into the dollar CAD. So the dollar CAD took out stops below 34, but managed to close slightly above 34. We're still above that at this point. Resistance will be 34.92 with support at 33.82. This market is really in bad shape, but you can see the 33.82 here and the significance of that. And resistance will be 34.92. Dollar peso continues to defend major support at 21.54. Support below the market will be 21.34 with resistance at 22 even. That was pretty much clear cut and dry. Still defending it, but below would be 21.34. But for right now, they're making a pretty good stab so far defending that, and we'll just stay with this 21.54. Below that would be 21.34. See what, we're just going to put that here anyway. There we go. So the dollar yen closed the week above 950, opening a potential for 1050 with that, because the key thing is that close. This is a key weekly. This is like absolutely huge. Remember before we always had it marked as 927 and finally we updated, but look how far this goes back. You see what I'm saying? Goes back a long way. It goes back to May of 2019, and the significance of this. So that with this close above that on the weekly opens the door for a potential. Doesn't mean we're going yeah, but a potential for 1050 since we closed above that. Resistance will be 987. Followed by 1018, but immediately it's going to be 987, and support will be 920. And let's go on to the dollar index. So the dollar index continued its downside draft to the support level of 96.42, holding on Friday, that was our bias chart support. We actually had 96.42 and 01, but held that first level of support there. You can see from Friday 96.42. Support will remain the 96.42 with resistance at 97.40. And with that, we'll go and move into the cross rates. So the Kiwi Yen propelled higher on Friday, challenging 71.50. Resistance to start the week will be 71.80 with support at 70.58. So even then, we still pushed up a little bit higher here to start the week, but you got some resistance there, 71.50. But 71.80 for today's resistance. With support at 70.58. On to the Euro Yen. Now the Euro Yen has experienced a phenomenal run to near 24.50. God, this run is just absolutely something else. Finishing with a slight pullback, you can see here on Friday. suggesting the move may need to pause to refresh. Resistance will be 24.12, and we did make it up here today to about 24.10, almost, or 24.08. Resistance will be 24.12 with support at 23.18, followed by 22.58. So you can see here a little bit of a pause here on Friday. You can see here after challenging nearly to 24.50. So resistance 24.12. And support's going to be 23.18. On to the Euro odd. The Euro odd continues to struggle at the lower end. The pair defended 62 even. Critical support to start the week is going to be 61.33. Resistance will be 63.42. Well, we've tried to make a stand here. Once again, positive news for the Aussie was that the Chinese data wasn't as bad. But once again, like I said, we're trying to make the stand, but they got to defend that 61.33. You may want to be wary of some stops. Now, like I said, we got that good news from New Zealand. They're fully opening up. That also adds a little bit of bullish tone, even though it's the Aussie as opposed to directly the Kiwi. If we can make this stand today, just keep an eye on that 61.33. It's going to be critical support. And resistance 63.42, looking further out. So that still remains. Looking at the Euro Kiwi. The Euro Kiwi is at major support, 73.09. It's there as we're speaking right now. I mean, it's 73.14, but we'll pull this further back. You can see the significance of the 73.09 here. That 73.09 is absolutely huge. Look at that. Going back to June of last year, so almost a year ago, you can see the significance of the 73.09. Real value level, and they're certainly challenging it right now. So the Euro Kiwi is at major support, 73.09. The pair should find value buying to start the week against this level, or just about right there. Resistance will be 74.09. So you can see here 73.09. And that's huge support. I mean, huge. Doesn't mean we can't dip below, but as I mentioned before, you can see all the amount of volume that's gone on at this level, going back to June of last year. You see that? So I would expect to see some value buying coming in here. We'll even put an asterisk because that is very key support. Doesn't mean we can't dip below it, but once again, like I said, should find some value buying in here. A lot of good volume that's gone on at that area here. Resistance will be 74.09, looking out. So the Aussie Yen pushed to new heights on Friday. The pair is encountering resistance at 76.50. Holy smokes, we're even beyond that right now. And the reason I had this pullback so far because look at this key level. This is when we had a year ago the big the big flash crash in the yen pairs. And look, we've made it back here, and we're even above it. I mean, this is just huge. But we do have some resistance coming in here at the 76.50-ish area. But it says resistance at 76.50, which may allow for a pullback. Support will be 75.45. Once again, the Aussie's so stretched. We may, I mean, this is really pushed so far. We may finally see this thing pare back a little bit, at least from this area. We are just so stretched. I mean, if you're long, you may want to really tighten up those stops. You've got some resistance right here in this. Pull back here. We've already taken out the stops here. Right there. So you can see here, coming across here. Right there. It's actually, it could touch a bit higher, which would be 76.91. Actually, we almost made it there. You see that right there? 76.91. That's a level right there. Key. Let's see if we can hone in on that a little bit better. $76.89. 76. There's actually 76.92. 76.92. I'll tell you what, we're going to update that to reflect that. Actually, we did have it before. Doggone, we did have it already. 76.92. So we'll stay with that and support if we get a pullback. Let's see where support would come in. Let's take a look here on 2 hour. Right there. 75.58. There's still some right in here that would come in right there, which is 75.82. Let's pull that down just a hair bit. So let's say, I think we see a further pullback, but at least initially, let's call it 75.77. We're way overstretched. And moving into the guppy. So the guppy took out stops above 39.11, rallying to 39.76. The pair may need a respite. Resistance will be 39.36. And it looks like today's high was 39.58. Wow. Resistance will be 39.36 with support at 37.46. So we'll see it could take a little bit further pullback. So we have 39.36. And we have broken out of this range. We got above 36.39, so we have to change that to bullish now. And support will be 37.46, so just a hair bit lower than what we had for Friday. And let's go to the sterling odd. So the sterling odd continues to hold weekly levels 80.89, which will remain support to start the week. Resistance will be 83.23. So 88.09, 80.89 is still holding, and resistance will be 83.23. And still, obviously, still bearish. And you can see here, Euro's still holding up here. Once again, if we're going to see a bit of a dip, and we'll see whether or not we see that today, but support's going to come in right there at the 1245-ish area here. right there, 12. Could be as low as, if you look right there, could be as low as 1238. But anyway, dips down to, I would think that a pullback is open to dips down to the lower 1240s. And you can see here, okay, and Mark, and sorry guys, I didn't see your messages, and I'm seeing them now. Okay, Mark says he's looking at the Dow. Apologies, Paul, I joined us a few minutes late now, no problem. And don't forget, Stelios records this and makes it available at around 6 a.m. Central Standard Time. 6 a.m. Eastern Time. But anyway, he says, do you think we may be starting an exhaustion or there may be a risk on and a run-up? Excellent point. Mark's talking about the Dow. Here's the deal is that if you remember, and one of the things I always like to do is I like to read the news so we get a little bit of a flavor. Well, we do have the Fed coming up. One of the things, and we're going to go and we'll move into the Dow now for you, Mark. Hang on one moment. Glad I saw those questions. Hang on one moment. Let's move into there real quick. Actually, we're there now. So Mark's looking at the Dow, and we'll take a look at the weekly here. There we are. And you can see where the key, let's pull this out a bit. Pretty key level here, this 27,169. You can see here, we came up in here. He's saying, hey, do you think we may be running an exhaustion? That's, I'll tell you what, it's almost like the $64, $64 question per se. You can only, at least for now, and I'll look at this right now, is that all we can do is look at the levels here. This is a prior key high, which is 27,376. Let's go and mark this off now. Try and at least give some insight in here. This run has been, let's take a look at a fib also. Let's see what we can do here, and then we'll expound a bit on here. So we're just past the 78%, which came in at 26,689. You'd expect a pause there, and we haven't. Well, there's a couple of things that come into play right now. I myself had tried to take a short, and I'd actually made a few bucks, but then on Friday, I ended up coming in, my own fault. It came in a little bit too early because that was key data on Friday. Remember, I knew that the employment numbers come in. I thought, okay, they're a little bit overdone. At least I thought, and I thought there was also some things you had to factor in, was just because, okay, I even saw a story that goodbye, bye-bye, second stimulus check. But right now, the momentum is with those, with the bulls that have been trying to push this even higher. At least as far as my own take, I should have waited at least for the completion of the first hour. But anyway, that being said, the market continued to go and push higher. The momentum is with those guys. Now, one of the things we covered in the news story was saying, hey, there's a lot, and Blake has said that before, there's a lot of money on the sidelines. People are going to be wondering, should I come in? And one of the things and just to give a little bit of a background, I remember Stelios had said, we'll probably see the top when we get past, well above 3,000, he mentioned, and people start piling in. So we have seen this. So are we there yet? Are we at this extension? What you want to do, I think, is if you want to play it, I guess we would call it on the safe side, wait till Wednesday when we get the FOMC, because here's the key thing. Remember, and one of the stories, and let me see if I can go back to that so I can touch on that, just to give you some, I'm trying to give you some background of what I'm looking at. A moment. Okay, here. So I even saved the story here. So here's what the person had said here, and which a lot of people have said here is, okay, here it says this. The market has been rallying on hopes of economic reopenings. Okay, that makes sense. But the actual oil demand, they're talking about oil though, but hold on. Actual oil demand has not risen that much yet. In a way, the market is supported by a flood of liquidity, said Tasafumi Okoshi. Now he was talking about the oil market, but he's talking about liquidity, the liquidity that we've seen from the central banks, mainly from the Fed. Now, I'm not questioning whether they should or should not. I mean, I think they probably needed to, but the point is a lot of people have made the most of that. Hey, you got to give them props. Those have played it from the bullish side, and one thing has stepped over another as far as being bullish. More reopenings, and then they got in those lower figures. We can question whether those, not whether they're valid, but I'm saying we can question whether the employment numbers, what gets accompanied with that, which is, okay, bye-bye second stimulus check. One of the reasons that we were holding up down in here, and I was following that closely, was because they said, well, we're expecting a second stimulus program. So now with those numbers, we got the boost from those numbers, but how much is still left in the tank? Because bye-bye second stimulus check. Can't argue that there's now, in some areas, yeah, you probably do, but from an overall perspective, you can't have it both ways. You can't say we need the second stimulus check because the economy's not recovering, and then now you have the market up here. Now, like I said, Blake has made this point before, the market is not necessarily the economy. But if you're here, you're thinking, okay, are we even going to get a second stimulus program because everything's opening up so quickly? Although another thing is that I was wondering in the market, Blake mentioned that too, is the market apparently doesn't even seem to care about any social unrest. And I think that'd be fine if we were down here. But look, we're up in here in the stratosphere. So the $64 question, as you said, is, hey, do you see it tiring out, or do you think we could push one more step higher? I think what we want to do is, if you're a day trader, you can step in and take a couple of pokes. Hang on a moment. Try to move to a shorter time frame. Here's on the 2 hour. You can take a couple of pokes in here if they're coming up to those levels. So what you want to do is you want to compare where are we into these levels, and you want to look at different things like momentum. Whether you're looking at RSI or you're looking at moving averages, saying on a very, very short-term basis, here's like on a 5-minute chart. I haven't put the moving averages on there, and saying here's like on a 5-minute chart here on the YM. So you can see this level coming up here. Pretty key value here. We'll go on and mark that off right now, which is 27,223. And not that you're necessarily looking at a 5-minute, but you can see here, this is an interesting value here. We got above this level here. We ran out of gas. We broke below it. We came back up. We got above it. Then we failed. We challenged it back again. So you can see whether you're saying, look, I'm not looking at 5-minute charts. I'm looking at a daily, or I'm looking at a 2 hour, or 30-minute. But you can see that there's an interesting value here. What you're going to want to see, and you can see even higher here. If you're looking, you're saying, well, look, I'm not trying to scalp it. I'm just trying to look going forward. Well, the key event right now is going to be that FOMC. And the reason that's going to be important, and not because you're thinking, well, do you think they're going to even do more action? No, the key is going to be what is Powell's take, because they've done everything that they can, including buying ETFs, trying to hold up the debt market, which is a key because they didn't want that to lock up. They wanted to make sure that we got that liquidity there. And to me, I think the markets have they've squeezed the turnip for all it's worth, I believe. I'm just saying, but you can't doubt what the market has done or what the bulls have done with this market. I mean, it's just been higher and higher. I mean, I don't want to say it's crazy like in the wrong way, but I mean, it's crazy like the extent that it's moved up. So they've squeezed every positive bit out of here. The way you're going to know, and I think is going to be key where we will know. And let me go on and point back out, and don't want to mean to stretch out, but I hope I'm providing without sounding like too much verbiage. I'm trying to give a good overall tone for you. One of the things that I was looking at on the way up was how the high yield debt market here for high yield corporate debt and the financials and the BKX. Look at these. These are above. When you go back here, these, like this level, this 84.13, that was the correction back from March. They've exceeded that. And you see the same thing here with the XLF and also the BKX. So they're above. They've already come back from those March lows and now have exceeded those. So there's honestly, when you look at there's nothing to say, oh yeah, they've run out of gas. I think that they probably, have stretched themselves quite a bit. But the key that I'm trying to relate is the way you're going to know for sure. And look at the Nasdaq; it went to new all-time highs. The way we are going to, I don't want to say know for sure, but the way that if you want to, this I guess it would be the smartest sense to go on and wait for something like that is going to be wait on Friday, not on Friday, I mean a Wednesday, and see if we get really the answer is going to be if we get some type of reversal. And that what that's going to be is, let's say we come into Wednesday and the FOMC, I don't know if there's a press conference, a presser afterwards, but they'll be looking through the text anyway. If there isn't, the key is going to be whether we move up to this high or not, or we stay here and we give back some of these gains in a more meaningful way. And one of the things we may look at, if you're looking, obviously, key is going to be this 26,158 right there. This area right here. Bear with me. I'll mark this off. There we go. And that's going to be 26,248. That seems like a long ways off. And probably thinking, well, God, that's a long ways off. For me, I like to look at the 2-hour charts. So I would look for something a little bit closer in here. But what I'd be looking for is some type of meaningful reversal that we can see on the charts, because they're going to go at the technical levels. Look at this. This market has not stopped. I mean, this is like, look, here's 161% of this high back in April to this low, May 14th, and 161% projection. We even went there, and look at this. We didn't even pause. We just went up there. We came back, tested back to it, and shot back up again. So the key is going to be, if you think about it, we've got a long ways to go. I'm not saying we're going to the March lows, but look how far we've rallied. So you don't have to worry about being early, being too late or missing out. The key is going to be is what's going to have to change the momentum. So if you've been, I mean, you yourself, but anyone else has been long, they've been right as rain. You can't doubt that. So if you're going with the technicals, you should just be buying. Now, other people may be looking at it, myself included, would say, well, I'm questioning this. I'm looking where there's areas on a very short-term basis where we'll run out of gas and step in and take the short side. But you can't deny it. The people that have been right are the ones that are long, and they're not. There's no need from a technical standpoint to change your tune, although I haven't been long. But I'm saying for you or for anyone else that has been long, they're going to keep on buying this thing on the pullbacks until they're proven wrong. So you have to look and say, what's going to give us that cost? No one is going to know that answer at this point because, and not to dodge the question, but could have said, oh, it's running out of gas here, new highs. Oh, it's going to run out of gas here, new highs. It's running out of gas here. Look, they're still coming in, people still coming in and flooding in that market. The question is, and the story, the guy mentioned the story because this is all based on just liquidity. This is all, let me take a look here. I just want to share something if I have it. I don't. Hang on. Bear with me. Here's a story, and I thought it wasn't a story, it was a tweet. It's this guy's Holger Zolschips. I don't know how to say his name, but he's a German. I don't know what he said, an economist word, but he's he's real in tune with the markets. Okay, but he says, and I know it's hard to see this, so I'll read it. It says this was on Friday. He says it's the liquidity stupid, which is a take on, if you don't remember, from the politics from back in the 90s when Clinton got elected. His political advisor, I can't remember his name, is a real well-known guy. He said, it's the economy stupid. So, meaning that's the reason why it's the economy. So he says, It's the liquidity, because everybody's wondering, we've made such a big run. And this is you can't see it, but it's a graph of here of the S&P 500. I'll see if I can expand this a little bit bigger. Let's see. Okay. Yeah, that's what he says. Okay, there we go. So it says, it's a liquidity, stupid. Central banks have exacerbated the divergence between equities and fundamentals. The latest rebound in equities was entirely due to the price earnings expansion. The S&P 500's multiple is trading in tandem with the Fed's balance sheet. Now, like I said, I'm not dogging it and saying, hey, we shouldn't be there, this isn't right. But I'm saying it's a liquidity. So my point being, and when you're asking, is this going to be it? It's going to be key with what Powell says. Because we've had now, they brought in all that liquidity. And to a certain extent, rightfully so, some people may question, no, they shouldn't, blah, blah, blah. So now, are we still going to have that liquidity? Now, it doesn't mean he's going to take away the liquidity, but what he does say, now if he says things like, well, we're still very concerned, this could happen, that could happen, then they know that liquidity is going to stay there for a while. We may get another extra shot. Now, if he says, we've seen a rebound, we think things, it's still important that we're there, but we're going to look at things going forward. Okay, then we may start to see the market kind of pull back. It may still hanging on for that day, or we may see a pullback, and then we may see a turn of momentum. Not that we go south of the border big ways, but that we have to come back in to find better value. And that better value could take us down here to this 25,409, which is pretty be a decent, reasonable pullback if you look at it not from way back here, but a decent amount to come back in here. So it's going to be key what he says. So what the market is looking at is, as long as we've got the liquidity, we're going to keep on pushing higher. The question is, who can pull away the liquidity or question the amount of liquidity it's going to be, and that's going to be what Powell says on Wednesday. So if you're looking from a technical standpoint, we can't question it. This market keeps going higher. Okay, although the S&Ps, I mean, look, we're back already above 3201. So you can see here, look what we had. We took this dip in here. We made newer lows, and look, now we've rallied nearly 20 handles off those lows. You see what I'm saying? So the what I like to call them, the Momo jockeys, the momentum players, from an intraday standpoint, they're just going with the momentum until they're proven wrong. You see what I'm saying? So what's it going to take? And you're saying, well, that's what I'm asking. Is this it, or is there one more run? Technically, you can't fight it. But who can fundamentally change it? Well, the person who actually put us in that situation, which is with the increased liquidity, which is Powell. So if he says, no, things are still concerning, this economy is going to take a long time, we're going to have to be there, then you'll see another leg up. If he says, well, we can't just go away quickly, I mean, but it looks like the economy is getting better. If he says the economy is kind of holding up better than overall, then that's going to reduce the amount of liquidity. The thing in the ointment is they're going to be the social unrest, but once again, he may make a tepid saying towards that as far as liquidity, but the take is going to be, does he suggest that they may need to pause to reflect? If he says they may need to pause to reflect, then that means, okay, we've probably reached the zenith of the amount of liquidity, and this market has been driven up on liquidity, so then we may see that pullback. So that's the best way to look at it. I hope I wasn't too verbose, but I wanted to provide like kind of like a better background than to just say, oh, I don't know, we don't know, we'll see what happens, wait till Powell. So hopefully that provides you with a better take on that. But that's all we have for today. Thanks for joining us here on the European Crossover webinar, and we'll see you in the chat room.